Hi everyone, it's Aleem here. In this video we're looking at exercise 14-17. Now what we're given is some information about Inspiration Management Corporation as of January 1st, 2023. And we can see that we've got some preferred shares and common shares in their shareholders equity section. No contributed surplus, so again we're going to have to take note of that. We've been given a balance of retained earnings, and then we've been given some transactions. What they're asking us to do is they've also given us a net loss. They want us to make an updated shareholders equity section of the balance sheet on December 31st, 2023. Now what they've said here is don't prepare the journal entries and just update the balance sheet, but for me, I don't think that's good advice. For me, I would probably do the journal entries regardless because it helps me understand the calculations in this question. So what I would recommend is even if they haven't asked you for the journal entries, it's always a good idea to do them anyway, just so you don't make silly mistakes in your calculations. Now, I've already started setting this up in Excel. I've got the name of the company. This is a balance sheet. It's December 31st. And then I've set up my shareholders equity section. The information that I have available to me for my preferred shares, it tells me it was a $3 dividend. We know there's 4,000 shares issued and outstanding. And then for common shares, we don't actually know how many shares will be issued as of December 31st, because again, we're going to have some transactions that might affect the number of shares we had. I always like to keep note in the margins of how many shares I currently have issued and outstanding, especially if there's a whole series of transactions and then I ultimately need to report it at the end. Again, it's a really nice idea to keep yourself organized so you know what's going on as a result of each transaction. The first thing they tell us is on February 6th, we declared an annual cash dividend on preferred shares. So let's just start there. It's a $3 dividend, and we can see there's 4,000 shares issued and outstanding. So this was on February 6th. If we're issuing the dividend on these shares, our journal entry for that is to debit retained earnings, credit dividends payable, and then the amount is going to be the number of shares, so 4,000 shares, and the dividend is $3 a share. That's $12,000. Okay. Then it says that also on that date, we declared a 20-cent per share cash dividend on the common shares. Okay, so let's do that. We're going to, again, debit retained earnings and credit dividends payable. No need to rewrite all of this. Let's just copy and paste. And then the amount is going to be based on the number of shares issued. What did they start us at? I think they told us we had 200,000 shares issued and outstanding. We'll use that information. So 200,000 shares times 20 cents a share. And that gives us $40,000. And we should be posting these as we go along here. We started with retained earnings of 465, I think. No, what did they start us at? They started us out at 626,900. Okay, so we were at 626,900. We just put 12,000 here. We just put 40,000 here on the debit side. What else have we done? Next, it said we paid the cash dividend declared on February 6th. That's going to be debit dividends payable, credit cash. Since that's not affecting shareholders' equity, I'm not going to bother posting that one here. They're telling you just so you know that this was ultimately paid, but that isn't what we're being asked to do. On June 4th, we're purchasing 6,000 of its own common shares at $15.25 per share. Now, for us to do this transaction, we need the average issue price. We can see that our common shares are $2 million, and we have 200,000 shares issued and outstanding. So what was the date of this? This was on June 4th. We're purchasing 6,000 of our own shares. For us to be able to do this, I need to do a little bit of math. And so I'll go over here on the side. We had 2 million. I hope that's right. 1, 2, 3, 4, 5, 6. Yeah, we got 2 million. Got to count the zeros. Sometimes that's hard to see when it's not formatted correctly. Oh, in case you're wondering, Control-Shift-1 will make it a number. And so that's what I just did there. We had 2 million shares, or $2 million. Yes, $2 million. And we had 200,000 shares. So we can see very quickly here, this is going to be $10 a share. Now, if it's $10 a share as our average issue price, when we're doing this transaction, we're doing this now at 15 and a quarter, or $15.25. Now $15.25 is higher than the average issue price of $10. So what we need to do here is to adjust, or to recognize that difference between $15.25 and the $10 that we're actually using to repurchase these. Okay, so again, that difference is going to be $15.25 minus $10. So let's go ahead and do that. Now, what's our journal entry here? We're going to be debiting common shares, and that's going to be at the average issue price. So we've got 6,000 shares times $10. Okay, so that's going to go down by 60,000. Then we know we're going to be crediting cash at $15.25 times the 6,000 shares. That's 91,500. This difference, if we had a contributed surplus balance, would first come out of contributed surplus, but we don't. So this is going to come straight out of retained earnings. And the amount is going to be 91,500 minus the 60,000, which gives you $31,500. Okay, so we'll put that over here. What's next? It tells us then that we do a 2-for-1 share split on the common shares, and we know that's going to double the number of shares, but it isn't going to impact our shareholders' equity balance. And finally, it tells us we've got a $78,000 net loss for the year, and so that is going to be closed to retained earnings. Because it's a net loss and not net income, it will further reduce our retained earnings by $78,000. All right, so that's all of the different transactions that we have for the year. Let's underline this. Let's just put a bottom border. And so now what we need to do is to compute the balance in retained earnings. So it'll be that minus the sum of all of these. And that gives us $465,400. And so now we can go ahead and we can fill in our balance sheet. Now, it told us that we have preferred shares, and we had $200,000 of preferred shares. That hasn't changed. So we'll just bring over that number here, $200,000. Our common shares, we need to figure out how many shares are issued. So if I say number of common shares, we started with 200,000. Then we repurchased 6,000. And that gives us 194,000 shares. Then we did a 2-for-1 share split. So it's going to be that times 2, giving us 388,000 common shares. So now I can go ahead and populate this, 388,000 shares issued and outstanding. And the dollar amount for these we need to calculate as well. Okay, so what was our dollar amount? Well, we started with $2 million here. Make that a little bigger so we can see it. We started with $2 million. And then we redeemed the 6,000 shares at $10 each. So we're going to say equals minus this number here. And that's also a dollar amount. Let's get rid of the pennies because it just looks weird. And so here we're at $1,940,000. My total contributed capital is the sum of these two numbers, which is $2,140,000. My retained earnings is a credit balance of $465,400. And finally, my total shareholders' equity is the sum of my contributed capital and my retained earnings, which is $2,605,400. There was a lot going on in this question, and I think had we just tried to jump right into an answer, we may have made mistakes. It's always a good idea to take these things one step at a time so you can see exactly what's going on and work your way through it slowly. All right, thanks for watching.